There's two names out there vying for the top spot in terms of market cap within the gold sector. While one is focused on producing the most ounces, the other is seemingly more focused on the quality of execution. But at the end of the day, those separate approaches don't really matter, considering both names blew analyst estimates out of the water in the second quarter amidst record high gold prices. Newmont was the first to do it, and then it was Agnico Eagle's turn. And boy, did they rise to that challenge. All right, folks, let's dive in. Agnico Eagle Mines in the second quarter posted top-line revenue of $2.8 billion, which was up 36% on a year-over-year basis from the $2.1 billion figure recorded in the second quarter of 2024. That revenue figure follows the sale of 847,000 ounces of gold during the quarter, which was actually down by 3.1% or 27,000 ounces from the prior quarter. This decline was more than offset by the rise in average realized prices per ounce of gold, which moved from $23.42 to $32.88 an ounce, a 40% increase on a year-over-year basis. Net income for the quarter came in at a new record at $1.07 billion, or $2.13 per share, which was an impressive improvement of 127% on a year-over-year basis from $472 million, or 95 cents per share. On an adjusted basis, net income was also at record levels at $976 million, or $1.94 per share, as compared to $535 million, or $1.07 per share, an 82% increase. Analysts had called for $1.68 a share. EBITDA, meanwhile, nearly doubled in the second quarter, rising from $1.1 billion to $2 billion, while on an adjusted basis, EBITDA improved from $1.2 billion to $1.9 billion. In terms of cash flow, cash provided by operating activities jumped 92% to $1.8 billion, or $3.67 per share, up from $961 million, or $1.92 a share in the year-ago period. And free cash flow hit new records, coming in at $1.3 billion, or $2.60 per share, which more than doubled from $557 million, or $1.12 per share in the second quarter of 2024. Cash and cash equivalents improved by $419 million over the course of the second quarter, which is said to be a result of higher operating margins, with cash and cash equivalents sitting at $1.6 billion as of the end of Q2. The quarter was a big one for the paydown of debt, with Agnico repaying $550 million, with Agnico's debt position now sitting at just $595 million, including $50 million of which is current. As a result, the firm's net debt position of $5 million as of the end of Q1 2025 transitioned to a net cash position of $963 million in the second quarter. Agnico also has a $2 billion unsecured revolving bank credit facility that remains undrawn, which doesn't include a $1 billion accordion feature that is uncommitted. Agnico in the second quarter also repurchased $100 million worth of shares, which translates to 836,000 common shares being repurchased, while a 40-cent dividend was declared as payable as of September 15th. All right, let's get into the operational side of things. Agnico in the second quarter produced 866,000 ounces of gold in the second quarter of 2025, which was down from 896,000 ounces in Q2 of 2024, and was also down from 874,000 ounces in the first quarter of 2025. Canadian Malartic remained as the biggest producer within Agnico's portfolio, producing 173,000 ounces of gold in the second quarter, followed by Detour Lake at 168,000 ounces and Meadowbank at 102,000 ounces. Both Malartic and Detour saw production improve versus the first quarter, while Meadowbank saw production fall 27%. Year over year, however, Detour was flat, while Malartic and Meadowbank both saw a production decline, while production overall was down at 6 of 10 operating mines year over year. In terms of costing, production costs on a per ounce basis increased from $862 to $911 an ounce, a 5.7% jump, while total cash costs increased 7.2% from $870 to $933 an ounce, and AISC rose 10.3% from $1169 to $1289 an ounce. Costs were up year over year simply as a result of higher royalties being paid due to a higher price of gold, which was offset, unfortunately for us Canadians, as a result of a weak Canadian dollar. As for guidance, things here remain unchanged. Agnico is still calling for 3.3 to 3.5 million ounces of production this year at cash costs between $915 and $965 an ounce, while AISC is expected to be between $1,250 and $1,300 an ounce, with costing currently meeting those estimate parameters and production at 51% of the midpoint target. And then there was the pipeline details. At Malartic, where Agnico is in the process of transitioning to underground mining, development reached 4,800 meters, including a ramp to reach the mid-shaft loading station to level 102, and advancements towards the shaft bottom at 1,100 meters. Development continues for the East Gouldie production levels, where production is expected to begin by the end of next year. At Detour, development began on an exploration ramp while the ramp portal was completed. Exploration has defined high-grade domains at the west pit that could possibly be mined early in the underground project, while drilling at the west extension zone at underground depths continued to show mineralization on the western plunge of the deposit. At Upper Beaver, structural steel began to be installed for the shaft headframe, while supporting infrastructure was completed at the ramp portal, with excavation of an exploration ramp expected to begin in Q3. Hope Bay, meanwhile, saw site infrastructure upgrades advance, which includes the refurbishment of a wing of the Doris camp and the dismantling of major components of the existing mill. While at San Nicolas, Q2 saw work advance on a feasibility study that is expected to be completed later this year. All right, so let's wrap it up. Agnico continues to be a sector leader, posting record net income and free cash flow, which is a function of the high price of gold, the weak Canadian dollar, and their ability to keep their costs low on a per ounce basis, which is why they are in a constant battle with Newmont in terms of market cap, despite the disparity in production figures, a gap that Agnico seems to be intent on closing based on the current pipeline. This earnings cycle has been strong for the majority of names in the sector, and it basically comes down to a rising tide that lifts all boats. In this case, that tide is the price of gold, which sure is a cliche and is a bit boring in terms of a conclusion to a strong report, but hey, what's there to complain about in this gold environment? All right, everybody, thanks for watching. If you have thoughts on Agnico's earnings, let me know in the comments section. Also, if there's stories you want us to cover, also just let us know in the comments section. We got lots of earnings videos on our channel right now. So if you're into mining earnings, you got to check out our channel. And if you want even more content, check out our website over at thedeepdive.ca. Also, if you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.